Hello and welcome to Options Guide TV. My name is Brian Overby, the author of the Options Playbook, but today's show is not about me. We have special guest Russell Rhoads. I'd like to think of him as the king of the VIX, in that he's written more books on the VIX than anybody. He also wrote a couple of books on weeklies, on some spread trading. So very excited to have Russell. We're going to talk about the seasonality of the VIX today. And we're going to look at a couple of Russell's favorite trades to do in the VIX. And I'm going to explore and ask him a few about my favorite trades to do in the VIX and see what his opinion is. So let's do it. Let's light this candle. Hello, everyone, and hello, Russell. How are you doing today?
Doing very well. It's always great to see you.
Oh, yeah.
A lot of people don't know that you and I worked at the same place, but not at the same time. And you spoke nicely about me, and I'm going to tell you something that I've never told you before. I don't know if anybody out there ever grew up with a big brother that they're always compared to, but there was an older instructor at SIBO that would always tell, if I was doing something he didn't like, he would always tell me how you did it, and I should start doing things like you.
Well,
So
I miss my days at the Chicago Board Option Exchange. Russell and I both worked in the Options Institute for a stint, and yes,
great place.
Yes, it was. I really enjoyed my time there, without a doubt. Well, today, and Russell, I want to bring up something that I actually reached out to you through X.com, formerly known as Twitter, and we always keep in touch. And I asked you to look at the seasonality of the VIX, going all the way back. I think how many years we went all the way back to 2004. Actually, is the chart that I have. And I think I'm going to start by showing that screen. So let me pull that up here a little bit, and we'll go in presentation mode. All right. And this chart kind of excites me and surprises me a little bit. And you can see my cursor. That's good. So I'm always kind of surprised, and I've noticed this before when I've seen a seasonality, quote unquote, chart in the VIX, is the run up between March and April. This is going back to 2004, period from 2004 to 2023. So the end of the year in 2023. I don't feel like in March and April we get that spike up in the VIX. Any thoughts on that?
Typically, April is the lowest average VIX close. I've done some things around that as well. Here's my theory on that spike. Okay. And everybody gets excited when you start talking about Sarbanes-Oxley, right?
Right.
But no, in all seriousness,
I'm excited right now.
Back after the internet thing happened, the internet bubble, we got some new laws, because we always get new laws whenever things go wrong. And one of them was something referred to as Regulation FD, where companies really can't share material information with anybody, including their investment bankers, etc. Also, if a company lies about their annual report, the CEO and CFO who attest to those numbers being accurate, they could face jail, which is a new thing since the 2000s. And that's not true for quarterly earnings, just annual earnings. Well, that spike in VIX coincides when we get a lot of annual earnings, and we get a lot more honesty in those annual earnings. So I personally think that, I know we've had some macro events around that time as well, but I do think that that's caused a lot of upward seasonality in March for some time. Mm-hmm. And then once we get those earnings behind us, everything just kind of drops off into April. So that's my theory on that one. And I'd seen that spike before. Probably some other good theories out there as well, but that's what I think is going on there.
All right. So now realize that this is the VIX index. This is the spot. This is everything that gets quoted on CNBC every day, day in and day out, and everybody likes to talk about it. 30-day moving average in the S&P 500 option contracts volatility is what the VIX is tracking. And then I always agree that in July and August, it's almost like it's just like we're rearing up to get some volatility in the marketplace. And I was actually a little bit mad in August when the VIX spiked all the way up to 60, because I'm like, no, that's supposed to happen in September and October. Why are you doing it now? So I was a little surprised to see that big jump up in the VIX, but we did talk about it here on Options Guy TV, and we did some bearish trades, so we assumed that it was going to come back into the range. Why so high? Why 60 in the VIX? Any theories on that at all, Russell?
Oh yeah, and that we love SIBO. SIBO was very nice to us.
Yes,
So, but I'm going to say a couple things that SIBO won't be particularly excited about. SIBO now quotes VIX starting at 2 a.m. Chicago time, 3 a.m. Eastern time, and they're using SPX options that are trading in extended hours with less liquidity. That live print that we got in VIX was about about an hour to a half hour before the regular market open. So I think we want to put an asterisk next to that 65. During normal market hours, it was closer to 50. But one of the things I found was about 40% of the daily highs for VIX since they started quoting it with extended hours occur during that extended hour period. So you've got to take that spot with a grain of salt. If you're like a lot of us, and we wake up and the first thing you do is pull up, you grab your phone, you don't check social media, you check what's going on in the markets. If you're relatively high spot VIX print, and it's 6 or 7 in the morning, some of that is going to be aided by the illiquidity in the overnight SPX market. So I always say you want to be paying attention to the front month future as well, because that's people actually putting money to work. And the front month future did get up to around, I think it got up to 37.10 when we had that spike, but not to the mid 60s, not at all.
Right. And I remember the trades that I got bearish with. We did some bearish butterflies, modified butterflies, but the VIX was actually, or the future was actually trading around 28 or 29 when we put on those trades on the show. Interesting. So when did do you have an idea when they started using the after hours?
It's great. You're going to make me look around on my computer a little bit. I feel like it was,
let's just go with feel like. Feel like is fine in most
2015, 2016, something like that.
Okay. All right.
But I like ran the numbers. Yeah, VIX extended versus VIX regular. I actually found the file, and goes back to, goodness gracious, goes back to 2016, April of 2016.
Okay.
That's where we're at.
All right. So now
April 15th of 2016. They're specific.
Wow. There you go. That was to the point. And that was quick. That was quick moving on with that mouse on that computer. If I look at this, so here we are in August. So we're right about, we're going right into September. Obviously today is the 26th of August, 2024. So we're going into September, and I actually kind of thought with the seasonality, and I actually sent you an email about this, I actually thought that September feels to me like it's a little bit more volatile than October. But we got the more of the spikes here in October, and even a little bit going into November, because November we're right about here. And that's the high on the seasonality of the chart. I still feel like September seems to be more volatile overall than October, but obviously the big market crashes have always been in October. Well, the ones of note, right?
Yeah. No. See, I think this is part of the issue with VIX, and some of the things that you've been saying. You've used the word surprise a few times with August, and Steve Sears, he gets the credit on calling VIX the fear index. And
Oh,
I personally think that when you really got to get VIX, when VIX really gets going, there has to be a surprise component to it. And everybody's braced for September.
okay.
If people already own insurance on the equity markets going into September, then you're not going to see as much of a reaction when we get a sell-off if people are prepared for it. And I'm right there with you. I I did not have on the kind of positions that I normally have on if I think that there's a possibility of a spike in VIX. And so I just totally missed this thing with one little exception that we'll talk about. But I felt like there was no rush. I had been looking at doing something with the September and the October future, and that opportunity went away and then came back as well. But I was like you going into early. I was like, darn it, I expected some sort of spike. I didn't expect it this early. And I think it was accentuated because a lot of people got caught off guard on that one.
All right. All right. Let's pop back out for a second here, guys. Just me. Go to me. And here, or well, Russell, that's fine. No biggie. We like to look at Russell's mug too. He's fine. So in here, I'm going to pop back out, and then I'm going to pull up, and let's just talk a little bit. We're tossing out a lot of terms, talking amongst each other here. I just want to kind of talk about the spot and what that means in the VIX and the actual futures. So the only way that you can get actual futures quotes for free without having a futures account, and this has always been a pet peeve of mine with the Chicago Board Option Exchange. And as a matter of fact, on the Retail Markets Committee, I actually got them, because I used to be a part of it when I was working for a brokerage firm, to quote the monthly VIX futures as an index on their exchange. So I think we can go to the CBOE delayed quotes right now. And when Russell said a couple of times, we said the spot, and I said the spot, that's the actual VIX index. But now one of the biggest things to know about that is that that's not the driver of the option contracts that go out further in time. So October, November, the underlying that drives those prices is the actual futures contract. And that's because you can trade the futures as a hedge, as a trader, and you can't actually buy the spot. You can't actually buy the index in the VIX. So this is what the traders are using the hedge. This is actually where the markets are at. And before the show, Russell kind of pointed out, this is messy on the Chicago Board Option Exchange, CBOE.com. If you type in delayed VIX quotes, you can get here. But these are the normal monthly contracts. And these are the ones that Russell and I would like to trade the most because they are the most liquid. So you got VXU4 that gets quoted, VXV4, which is October 16th, and VXX4, which is November. And you see that, yeah, people are nervous about what's going to happen in October. 2 points in the VIX is fairly big. And I guess I just wanted to get Russell's thoughts on that.
That October future has been poking its head up for a while, and it's I'm gonna have to come up with a new phrase for it. I was referring to it as the Trump bump or the Biden bump because it's related to the election. Now we all know that the election is the first week in November, but if there's still a lot of uncertainty and a lot of concern about the election, and it can go from people being very upset and misbehaving to somebody getting elected that you think may be bad for the financial markets. I ain't touching that one. But the higher the risk, the higher the uncertainty, you're going to have increased S&P 500 index option premiums for options that expire after the election. And the October future is going to settle into a calculation using those options. And that's why the October contract is a couple of points higher than September right now. I feel like, and I do feel like September's getting neglected, and a lot of people are looking past that, which may create some sort of a surprise, surprise price action. If not this week, shortly after Labor Day, before the before that expiration. That expiration is September 18th. So we've still got
Right there.
about
Yep.
3.5 weeks or so for that one. So and if you go back and you look at the curves for all the elections up to the last election, you didn't see October poking its head up like that anymore. But after 2016, when the outcome was different than everybody thought, we've suddenly started pricing more risk into the election. We saw this in 2020, but we also saw it flatten out as we got into mid-October. And if that follows again, selling October and owning November might be a pretty good trade right now. They're only a 50-cent difference now. It widened out to about $2 when we had that most recent VIX spike. You were talking about that the butterfly that you did. I was actually able to short October and buy November. And when it was at 210, the spread was 210. I got out of it now that it's at 50 cents. So that's just something to keep in the back of your mind. And you can see with the volume that everybody really does pay attention to the front month. And I like to quote Ed Thorpe, who I trapped alone for 30 seconds. And the only answer he gave me when I asked what he was looking at in the market was he's always looking where other people aren't. Well, look farther out on that curve for opportunities. You don't have to trade the front month.
All right.
So something to always keep in mind.
And then I want to put one last caveat before I leave the delayed quotes is that now realize that eventually the spot matters. So as we approach the actual expiration date, the futures contract price and the VIX index are going to come in line. So if you really want to trade the movements in the VIX index and you're just quoting the VIX, the only real way to do that is to do very, very short-term options in the VIX. We're not saying that you should do that. I'm just telling you that that's going to have the actual most effect on the option prices based off of the spot or the actual index. Okay, so let's jump back out. And now, based off of the seasonality, Russell, that we looked at and the chart that we had all put together, you and I came up with a couple of trades before the show. And would you like to start? Should I jump into my trade right away, or do you? I mean, you're the guest. Do you want to go first, or
quick? And what I did was I've been looking at going long September and short October.
Okay, let's run to the Tradier Pro software. Let's run there right now. Okay.
So I've been looking at getting a long position in September and a short position in October. And this is not because I think we're going to see a volatility event. It's in case we get a volatility event. Because when we did before, we saw September run up a lot more than October. Right now, the September futures at 16 and the October, basically 16.10, and the October futures at 18.15. My anticipation is if we see some sort of volatility event that happens before September expiration, that it will show up in the September contract, and we'll go from really steep contango to backwardation. And one way to trade that is to buy the September future and short the October future. However, I like to trade the options. And what I did was I bought an in the money September call. I bought the 13 call for 330. The future was at 16.10 at the time, so my break even.
It's actually at 330 right now. As you
I know. Look at me. That might be. Is that volume? Is that just my volume? Am I 100% of the volume there? I'm kidding.
I can't answer that. I don't have the volume up.
Well, I just saw that little green bar there. I was like, is the volume 1? And it was me because it was a big one.
I can.
And then I went out to October, and I bought the October 25 put, and I paid $8 for that. So my break even on October is 17. The volatility on October options is much higher than September options, and the time value is as well. Really, it's just because October is a contract that a lot of people are keying off of. But if we do get some sort of volatility event, I likely will take off the that long call on a spike,
This
because you
one,
always want to
right?
monetize the
This
VIX
one
trades.
right here.
Yeah, but if nothing happens, I feel like we'll probably see if nothing happens and VIX drifts lower, that October contract's going to drift lower as well, and I feel like it would offset some of the losses on that long September call.
All right. So right now, if we put that trade on, I just want to highlight it. This is the trade in the order take. Did you leg into the trade, or did you set it up through it all as one?
I legged into it because in reality, the September and the October VIX options, they have a different underlying.
Yeah.
It's a September underlying and an October underlying. And so I just I tried to I got a little cute. Like you said, I did good on the option that I bought on the call option I bought. The put option probably could have waited a little while because VIX has started grinding higher since then. But I'm happy with my trade. Probably could have
I'm going to
executed
go
a bit
back
better,
and I'm going to reference that in that there's really not a lot of benefit to adding when you have two different underlines, because you literally are trading. They're 2 points different. You know, that's a lot on a 16-point index. There's really not a lot of benefit because the market makers can't hedge with with one future for that entire gaggle of trades for both legs of the trade. So working it by just sending it down to the floor as individual legs is fine in the VIX. Right, Russell? Just sum that up a little bit.
Absolutely. And
Okay.
and again, I don't think, typically if you do a spread trade, and this is a spread trade, and you send it as the spread trade to the market makers, if there's a lot less delta relative to the underlying, like you're doing a call spread or something like that, it's cheaper for them to hedge it, and you're more likely to get executed kind of in the middle, because each of these legs would be hedged with a different instrument. It just it doesn't help to execute. You can execute it that way, but I don't particularly see the benefit.
Yeah, you said that way better than I did. I get. Okay, excellent. So that is the trade. It's actually trading fairly close to where Russell put the trade on right now, just right at the midpoint by putting them both in that order ticket. But you were talking about some fun things that you've discussed on a few other shows about the UVIX. So the UVIX is I mean, I'm just going to call it as it is. It's an ugly underlying. It's hard to understand, and I don't know how well does it how much does the actual VIX really affect the UVIX? Like, how is the spot index represented in UVIX?
Yeah, what's really funny about what you just said is, and this is an intraday thing, it's not a long-term thing. Intraday, UVIX follows VIX closer than any of the other ETPs.
Interesting.
It's a 2 times long, and it's giving you exposure to the front 2-month VIX futures. But the folks behind UVIX a while back just demonstrated that it's the closest thing to day trading spot VIX. Now, the issue over time with UVIX is the same thing. I think a lot of people are familiar with VXX, that gives you long VIX exposure by owning the front 2-month VIX futures. However, every day we're selling a bit of the front month and buying a bit of the second month. And right now, with the September at a 2-point discount to the October contract, that creates some negative performance. The VXX folks refer to it as a negative roll yield. But I did find, over time, it's just going to grind lower, and it is a terrible instrument for that. But I found, somebody asked a question, and I started running some numbers. I found if you buy UVIX on the close every Friday and sell it on the open every Monday, you will lose you'll lose money a good portion of days, but every once in a while you get a big homer. And I found I came up with this in early January. I'm sorry, in early July, and started trading it every weekend, and got really lucky with the October or the goodness gracious, I'm on fire with months with the
August,
August 5th
August, right?
move.
Mm-hmm.
And I was able to score a really nice almost $900 gain off of $1,000 purchase on that one.
Oh my God.
But over time, on average, you would make 0.9% on that trade. Buying it on the close on, which covers your commissions, which buying it on the close on Friday and selling it first thing on the close on the open Monday, and it basically gives you a hedge against overnight risk. There are a lot of theories as to why that works. One is the market makers do take their implied volatility inputs down on Friday afternoons, especially when things are kind of slow. So, and maybe it's, benefiting from a reflation of implied volatility on Monday morning. But if you did that if you bought $1,000 worth of SVIX, starting when it was launched in
SV or
March of
UV? You
2022.
just said SV.
I'm sorry, UVIX.
Yeah.
Yeah,
Okay.
I apologize because I do a lot with SVIX as well. But and both of those launched at the same time. But if you bought it on the close on Friday and sold it on the open on Monday, and you just bought it you did that with $1,000 worth, you'd have already doubled your money.
Okay, so basically, first of all, it's an ETP, which stands for exchange traded product. Some of them are notes, but the one that's the most popular is an ETF, right? The SPYs are an ETF, exchange traded fund. But when you get into these weird things, they call them exchange traded products. So you can buy this. And what Russell is really saying is most of the time, you don't really get hurt on the downside. There's potential that you could if you bought it on Friday and sold it on Monday. But most of the time, you're kind of break even on that. And every once in a while, you get that huge spike up, which happened with what Russell says in August. So, and that also just in general, if we have big down days, most of the time, go back in history, the big down day is on a Monday. And obviously, you have a lot of news that hits the market on Monday morning from over the weekend while the markets were closed. So, yeah, I really like the concept of it, just thinking about all the big down days you've had on a Monday. And if you can break even most of the time and then every once in a while get that black swan event, then bam, I love it overall. You're on mute, Russell.
I am.
Well,
you can't hear me?
Your lips were moving and we weren't hearing noise, so I don't know what that means.
Can you hear me now?
Yes, we can.
Okay, cool. I think I think I gotta clear my throat and then the microphone wakes up. We talk before we do this. Nobody should be surprised at that. And you did ask me about options around this one. The thing is, I've been trading it. And then I also will pay attention to different potential options. And the thing is, the bid-ask spread on the options is about a nickel or so. And you do get a little bit of time decay. So it just doesn't work with options. And then I also looked at, well, what about, offsetting some of the cost and selling it out of the money call? One of the issues with that is if you do that, if you sell like a weekly out of the money call, you're going to give up some really nice profits, and
right.
That
you don't want to be capped on the upside. This isn't something.
Exactly.
I totally understand that.
Yeah, I did a Dr. Strong down at LSU, who's done a lot of work in the option space. I wrote a CFA piece with him, and he would always refer to covered calls as giving up the sweet spot of performance. I think that's an overstatement, but it is something worth pointing out.
Well, yeah, and I agree. A lot of people chase volatility with covered calls, wanting to do it around earnings because there's juice. And that's the exact time when I don't want to do it. If I'm trading something that has the potential to double or triple, which would surprise the market, I just don't want to give up that upside. So I like that. I like that little phrase. That's fun. That's a fun phrase. Might use it at some point in time.
Yeah, and it does work with VXX as well, but we won't dig too much into that. Not as well, but has worked there as well.
All right, so we are running a little bit up against the time, and I do want to say that if you are on inside the Tradier Hub and you log in, you can ask questions of Russell and myself. And also, if you're in the YouTube platform, and obviously you're logged into your YouTube sign on, you can ask questions. Just put them in the chat box. We'll try to address them. I'm going to bring up my trade, which I was excited to share with Russell because, first of all, it worked when we did it on the downside when the VIX was trading, when the actual spot index was right around 28, 29, and futures were trading fairly close to that too. So I'm going to bring up my trade, and I'm going to do that because I got it all set up in the what if calculator. And here, let me go and actually send this to the trade ticket if I can. 1 second here. It takes me a second for some weird reason. I can't use my fake mouse to do this. And then let's send that to the trade ticket. And if we're in here, this is the way it looks. Okay, first of all, I was going to do the September contract, and it's the fact that the September contract is trading lower than the October contract is a reason. Another reason is with butterflies, it's really hard to get paid until you get closer to that expiration date. So if I'm looking at the VIX index, and let's pull that up. That's what was kind of screwing with my head up there. Like, why are these so low in price? But if I look at the contract that we're talking about is the 18th. And here's what I'm highlighting inside the Tradier Pro software is if you see the W here, these are weeklies. Russell and I already mentioned this kind of flippantly a little bit, that they just don't have the volume. The markets are harder to trade. This is the good old fashioned VIX index, the monthly expiration from way back when it expired. They stopped trading on Tuesday, and then they have a settlement value called, which is actually under the symbol VRO, and it comes out every Wednesday. And so you want to look for these. These are the contracts that we want to trade. And Russell mentioned it's 3 weeks out, 23 days to be more accurate, September 18th. So I obviously, looking at the seasonality of the VIX, expect to get a little bit of a move to the upside. And here's the way I set up the trade. This is a butterfly. Now, a standard butterfly, if you're doing it, we're going 6 points wide. So buying the 18 strike, and this is the call side of things, the actual spot index is right around here. And actually, the actual future contract is the futures contract is trading fairly close to that. So we're going to buy the 118, go 8 points out, buy the 24, and then from there we're going to go up to the 29. So we're not going to go a full 8 points on the upside. So we're stopping short on the butterfly. We're making our short spread on the butterfly not as wide as the long spread. And what it does, and this is an index that I particularly like this on, if we go back to the what if calculator, and by the way, look at the it's 36 cents. So $36 for every 1x2x1 that you put on, and that's your maximum risk on the trade. So if you just do one unit or one butterfly, you're paying $36 for it. And then if you go to the what if calculator, what this does is you'll notice here's the zero line. Let's pull this back down. And there, we're still there. Okay. Here's the zero line showing that the break even right now is about 1834. So you do need that movement up, and it needs to sustain all the way up until that September expiration. Maximum loss is going to be that 36 cents it says right here. And then on the upside, though, if we actually get the blowout move, the black swan event above 29, you're looking at still making a double almost. I got to focus over here. This is where the profit and loss is at. But you're talking about $63 on a 36-cent trade. And obviously, you got a home run right in the middle. And one of the things that we did with our short version of this using puts is we actually ended up settling like within 50 cents of our short strike. And that was on the actual settlement day. These are cash settled indexes. I love that fact. So just cash goes in your account where options used to be. And there you have it. And this is the trade that I'm looking to do based off of the seasonality of the VIX, and hopefully that seasonality stays true and we get a spike up, ideally somewhere within the, I'd like to be somewhere between the 20 and 24 range. But we still got 3 weeks. So you only really get paid if we get closer to expiration. This is as of today, and that's not normally that's not going to be accurate because you're based off of the futures, but the futures trading fairly close to the spot. So here's the difference as of today and as opposed to at expiration. So big difference in that profit and loss graph. All right. So we'll leave it here. I want to get Russell's last thoughts on this trade. And if you have any questions, we'll try to address them. And if not, this will be our last little foray into the VIX going into September and October.
First off, I really like the trade an awful lot. I think it's a great way to get long exposure to VIX. I see spreads periodically where if VIX overshoots, you've got some risk. I love that if VIX overshoots here, you make some money. I like using VIX like this. Let's just say between now and let's just say this week, the S&P 500 goes up a couple of percent. Just a hypothetical there.
Mm-hmm.
If you had done some sort of trade guarding against a volatility event in the SPX, all of a sudden, whatever options you used are 2% farther out of the money. VIX holds its value a bit differently, and it's why spreads that I think you said it in passing. It's why spreads that we don't like in a lot of other markets, we actually do like in VIX, and it's just the behavior of VIX. And then finally, I like these sorts of trades. You know, your risk is if VIX is below 18. And when I'm doing the whole thing and I'm trying, talking to a class and I'm trying to get them to say things out loud, I'll say, well, what does it take for VIX to go down? Well, the S&P 500 to go up. So if this is something that's mixed into a portfolio that has a long bias to it, a long equity bias, it's a great trade. You'll make it up elsewhere if it doesn't end up working out. But it will also hold its value up until the last few days before expiration. So if we haven't gotten the spike, you'll probably be able to get out of it at a decent price as well.
Yeah, if you're hanging right around here by that September date, just sell it. If you got a week left, right? And you're probably going to get out for 20 cents.
Yep.
So, all right. So would you say my grade was an A on my?
You've done very well, and you can.
I like that.
Now you can come guest lecture to my derivatives class at Indiana. That's what
I would love to do that. I've Margaret Smoller over in she was a good friend of mine that I worked with when I was at Knight Financial Trading Group, and I lectured to her class a couple of times. It was a lot of fun. I really enjoyed it. All right, Russell.
They love derivatives.
That would make sense since it's a derivatives class. I love that. All right. Well, that we are way over on the time. Sorry. So that's wonderful. Thanks for coming. I guess we got to do I guess this is a once a year thing now, Russell. We got to get you back a little bit more than that. But with that said, any last comments or thoughts that you would like to share with the group?
Just I'm eyeing that September future right now. I just feel like it. I can't believe it's at a discount to spot VIX right now. I just can't believe that.
Too, yeah.
So
with that said, gosh, buy a call option too. That's not that bad of a trade right now.
No.
The VIX is down around 100, which is the VIX of the VIX. We'd like to have that down around 90 or 80, but heck, the fact that you're getting such a discount on the September future, just buying an in the money call or even speculating on an out of the money call isn't a bad trade either. All right. Well, that's going to be it for this edition of Options Guide TV. Russell, thank you so much for coming on the show. It's so much fun.
Sure.
I totally enjoy it. And we'll be back on Wednesday. I am going to put this trade on in my account, the one that I just showed you today. So we'll watch it through the month of September. So if you want to come back and get some periodic updates on it, definitely going to be doing it. And see you this Wednesday for the next edition of Options Guide TV. 11 a.m. Eastern time inside the hub on x.com and also in the Tradier YouTube channel. Thanks for stopping in, everyone.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.